10-year note yields continued the one-month trend, heading lower, albeit only slightly today. When you look at what happened in the equity markets, the crash we saw over there, you would have thought yields would have gone down more, but really the yield trend has remained pretty steady since that high back about a month ago when we saw yields touching close to 190, and today we're nearer to 150. We're about 155, 154, but we're nearer to 150, likely on our way back to those September lows, which would take us down to about 142 or lower if things continue on this path. So as we continue to see modest upticks in yield, modest selling in treasuries, it is met with eager buying, and that is what's really controlling the markets at this point. And as the Fed and the issues with global growth, and when you see in China and trade and whatever, all that continues to remain unresolved, that will continue to push treasury yields lower. The uncertainty and sort of the flight to quality bid that we are seeing has no reason to end, at least not today. And I think we'll get more and more pieces of the story as the month of October go forward, with a couple of key events towards the end of the month. But I think at this point, we're going to see steady as she goes. Yields will continue to trend lower. And if you look at market volatility, the fact that we've been in this trend for quite some time, where volatility is well off its highs, we recently made a run towards the year-to-date highs and have since reversed. We are trading right now at the 14-day moving average, which doesn't sound all that bad, although we haven't been there in over a month. So we've been hovering well above the 14-day moving average, and that's really kind of where we've seen this spike higher in yields and then the quick reversal lower. But now we're back on track, and I think at this point, market volatility will need to see a big move lower in yields in order to see volatility move back towards those highs. That means getting us south of 1.5. That means getting us back towards that 142 low, which again I think is on its way. But at this point, we aren't there yet. So wait for the move, the anticipated move through that level, and volatility should reverse higher as it had just recently when we made the last move down to 142. And lastly, what do we have coming up? Obviously, it's the September FOMC minutes will be out tomorrow, and they're not going to tell us anything we really don't know. Maybe some of the disconnect between the Fed governors and the Fed presidents, the last meeting about the rate cut, and maybe talking about how the path forward should lay. I think at this point, the market is very well priced for a 25 basis point cut at the October FOMC. However, what comes after that is going to be very unclear. The market's about 50-50 right now of a second cut in December. So right now we're seeing need some clarity. The minutes typically provide some more details than we get from the statement in the press conference. But in this case, I think it'll probably be more window dressing than anything else, unless there's some way out of left field, color commentary in there that shifts things way off where we're going. And at this point, the FOMC minutes don't seem to be able to do that. Looking way down the road, though, it's really October FOMC, which is October 30th. A day later is going to be the official or unofficial Brexit. So you've got a lot going on there in those 2 days at the end of October. That really could be where the market is focusing right now, and tomorrow's FOMC minutes may be being overlooked. So if there is a surprise in there, it really isn't priced in. But right now we're looking for 25 basis point cut at October, possibly 25 in December, and in between there you're going to get a Brexit announcement, or maybe you won't get a Brexit announcement, but at this point we don't know that. So Treasury yields right now trending lower and look to be continuing to do that through the month of October.